conversation is no longer about should we own emerging markets. It's like what piece of emerging markets should we own?
Speaking to a couple of managers recently, it's almost like there is no other story. It is that at the moment.
Any way you cut it, it doesn't look great for the UK.
Welcome to The Heart of Wealth, your weekly pulse check on the wealth industry. I'm John Schafer, your host for this week. Today on the show, a decade after the Brexit vote, how have UK funds compared with European strategies? What's been driving a rally in emerging markets? And finally, the Treasury confirms it will tax cash interest within stocks and shares ISAs. Joining me today in the studio, we have CityWire journalists Ruan, Jooste and Olivia Bybel, as well as James Penny from TAM Asset Management. Thanks all for joining me.
Thank you for having us.
So we've been 10 years out since the Brexit vote, and CityWire looked at some of the implications for investors. Olivia, you dug into what's been happening with UK equity funds v European equivalents. What did you find out?
Yeah, so we looked at the performance of the equity markets overall, and then what's more core for us, which is how active managers were able to perform in those markets. And we looked over a couple of different time periods. Any way you cut it, it doesn't look great for the UK, so I think Brexit voters might have been a little disappointed reading the piece. In the 10 years since the Brexit vote, Europe has outperformed the UK on an index level, but also all of the top performing funds have outperformed the top performing UK funds. Over the other two time periods, we see that change a bit. So we measured after Brexit was completed and then a 5-year period as well, and the UK funds start to climb the leaderboard a bit.
Okay. I mean, the underperformance of UK funds v European funds, how much of that is actually down to Brexit itself? I know that'd be quite hard to quantify.
Right, it is. So our data editor actually did some analysis on this that we included in the piece. So Brexit caused a couple of things pretty directly. So the pound slipped 10 years ago after the vote. It hasn't since recovered fully. The economy has struggled, and also there's been a large flight of domestic assets out of the UK. So all of those things have affected the equity market and also these active funds pretty directly. But as Dan kind of found out in his analysis, you know, the UK and continental Europe equity markets are very different. So the UK market's high exposure to cyclical stocks and value stocks, which are some of the reasons why they've been performing well recently, as there's been a turnover from growth, have also meant it's been more vulnerable to economic shifts. So the COVID-19 crash affected the UK market a lot more than the European market, and that was also within this 10-year period.
I completely agree. It's been a challenge for the UK. It's been a difficult time to be a UK investor, and you've certainly seen a flight out of the UK. You've also seen investors, and sentiment-wise, especially when Brexit kind of happened, moving out of the UK. And certainly what we've seen is you've seen more investors moving back to the UK recently as that kind of cyclical value tilt has started to come back in favour. That being said, you know, you've consistently seen the UK allocation with MSCI World continue to shrink and shrink and shrink and shrink. And I've seen so many managers that used to have 20, 30% of their portfolio in the UK, now having 5, now having 3, and it's a lot less. And I think it's been very difficult for UK bulls to fight against that. And some people then it's given rise to the perception that the UK is not investable. You don't have the right companies in the UK, or the companies can't profit from the current environment. And I don't think that's the case. It's just been a real headwind. Yeah,
but do you see that changing, the tide changing a little bit? You said very low allocations amongst maybe your peers, and I don't know your own firm, what's happening there. But I mean, more recently, FTSE's been pretty good.
Yeah, definitely. Especially looking at the 100. The 100's been great, and the 100 arguably is a more international beast than the 250, which is more of a domestic play. TAM's holding one of the largest overweights of the UK it has done in a long time. And that's the great thing about active management, is we can move that up and down as we want to for clients. But interestingly, when I look at global managers, perhaps not growth managers, but unconstrained global managers, they're also holding overweights to the UK at the moment. So I can see that coming through in some of our positioning. We ran some analysis on the portfolios, which showing at the moment we don't even need a direct UK position in our portfolios, because a lot of our global managers are doing that for us. So actually, buying direct UK is doubling up on the concentration that our active funds are already selecting, which is interesting.
Okay. I'm going to move on to emerging markets and potentially why there's a bit of concentration risk there and why there's been a rally in emerging markets. The South Africa site ran a story this week on a Ned Group emerging market fund that had really outperformed its benchmark by quite a way by sort of heavily relying on semiconductor supply chain stocks. Ruan, could you give us a little bit of colour on why emerging markets have done so well recently?
Well, flows have been kind of supported mostly by the AI boom, like the rest of the world. And as you mentioned, it's kind of concentrated around the semiconductor supply chain. The weak dollar, of course, supported flows as well. But, valuations are much more attractive than it used to be against US equity. So it is an attractive place to invest. But, concentration risk is becoming a bigger worrying point for investors at the moment.
Because you were at a conference in London this week with a load of South African investors. What were their concerns? You mentioned concentration there. Could you dig in a little bit deeper?
Yeah, absolutely. The conversation is no longer about should we own emerging markets. It's like what piece of emerging markets should we own? The MSCI EM index, 50% of it is Taiwan and South Korea. So, there's kind of more looking at certain regions and sectors, the Philippines, South America, Vietnam, those type of countries are names that are popping up to see if there are any opportunities over there.
And there's possibly a sense that those valuations are a bit stretched, just like in the States, really.
Absolutely. And of course, passive strategies are no longer considered diversifiers. So people's like, active management is the way to go if you want to extract value or, diversify in emerging markets.
And could you give us a bit of the sort of South African flavour? Are investors in South Africa looking domestically? Are there good opportunities there?
Yeah, look, South Africa's not really featured in any kind of emerging market portfolios or have a significant position in those portfolios. But you know what? Some of South Africa's solid stocks have single PE ratios, have really attractive dividend yields, and our fiscal outlook and our infrastructure investment programs really has made the picture much more rosy than it used to be. So there are really some really good stocks, particularly around the banking sector, some mining darlings, and even our two big tech stocks, Prosus and Naspers, which is made investors very happy over the years, is also a big feature. So, yeah, I always say, when there is kind of, when you ignore something, there's always some opportunity hiding there somewhere.
James, I'm going to bring you in again. Emerging markets, what do you think of this sort of rally? I know it's maybe dipped off it slightly recently, but it's been pretty impressive. Is that somewhere you've been investing?
Sure, yeah. We've held an overweight to emerging markets for a long time. Used to be a diversifier. Used to be a great place to find loads of really, really interesting companies that you perhaps wouldn't find in your traditional indexes. Of late, that's concentrated down. Of late, that's become almost one story. Speaking to a couple of managers recently, it's almost like there is no other story. It is that at the moment. And I was like, well, what about all the phenomenal companies around that story? Are they not worth looking at? And I think the message from the emerging market managers is, yes, absolutely, that's the next iteration, that's the next stage. So I think emerging markets is a great diversifier. We're long emerging markets. We think it's a great addition, and I'm delighted that it's starting to become a bigger piece of people's portfolios consistently. And I'm certainly looking for that active management piece to come through, rotate out of perhaps the heat of this market, which is really concentrated in EM, and start to move into some other stocks. And that's where active management, I think, is absolutely critical. That's how we're playing at the moment.
Yeah, because I suppose you do want to have a feel that it's an actual diversifier in a portfolio.
For sure.
Yeah, because if everything's chasing this AI boom, it's a little dangerous.
Very.
Absolutely.
If you run the analysis on exactly where your alpha is coming from in an active portfolio and how much of that is being derived from a clutch of stocks in emerging markets in the US, you look at that, and for your clients to deliver that long-term value, you want to diversify that. You want to look at how you can work your way around that. And this is the thing I love about investing, is there's always another opportunity. There's always something else that you can look at to diversify that, but stay with it.
Let's move on to our final story. It seems that the Treasury has confirmed it will apply a flat rate tax charge of 22% on cash interests within stocks and shares ISAs. James, I'll bring you in again. Do you think this is a good move from this strategy? It's been facing quite a bit of criticism the past few days.
From talking to clients, I think clients understandably don't appreciate the government influencing how they behave with their hard-earned wealth, and I sympathise with that. From the government perspective, I suppose they want to invigorate, respur, get people back into investing. I think what they want to do is get people back into investing in the UK, which is an undervalued market. Urging people to do that with their cash is probably not something I think was a good idea, is to get people to invest. Certainly that's what I'm picking up from the client side of things. But I am supportive of the government trying to initiate investment, trying to get people to invest for the long term, trying to think about their pensions in a different way, trying to think about that long-term outcome. I can see it from both sides.
Yeah.
It's quite interesting how governments are looking at the financial sector to kind of fill those gaps in their budgets. South African government brought out a proposal on how to tax hedge funds differently than the rest of the collective investment scheme, because that's considered more kind of the wealthy segment of investment. And the backlash was quite significant. Investment managers, I could look, it's going to complicate the matter. Its compliance is going to be more complicated. It's going to actually add more cost to the consumer, and it's going to defy the point of the diversifying effect of hedge funds in certain portfolios. So it's back open for public comments. After that big backlash, it's going to be interesting to see where that's going to end up.
Excellent. And that's all we have time for today. Thank you very much to our guests and the production team. Join us next week.